Hello, my dear future company secretaries. Hope everybody is doing great. Myself, Chinmaya Hegde, your learning partner for Corporate Accounting and Financial Management CS Executive Paper. I'm here to review the question paper of the CAFM, which is held on December 2023 examination. Overall, my view is kind of mixed. There were some easy questions and there were some tricky questions. So, which are those questions and a different level what they have asked for? What are the areas they are focused on? Which is what we are going to cover in this video. Before I go to the questions individually one by one, first let me give you a recap of what is your syllabus first. 60 marks corporate accounting and 40 marks financial management. So what you have in corporate accounting: introduction to corporate accounting, basically based theory. These two are theories primarily. Accounting standards, a summary of accounting standards. Accounting for share capital, you have quite a few numericals. Accounting for debenture, yes, you have numericals as well. Related aspects of company accounts, yes, this is common between share capital and this. There are quite a few common areas. Consolidation is a purely theory, a practical chapter. Financial statement analysis, a kind of new which is analysis or ratio analysis. Yes, from that also question was asked. Numerical. Cash flow is numerical. Forecasting is a new area which is introduced in your syllabus, also a problem oriented or a practical oriented chapter. Financial management, introduction is theory, time value of money is compounding interest, capital budgeting is investment decisions. Yes, problem will be asked. Cost of capital, capital structure, dividend decisions, working capital management, security analysis, and operational approach is primarily little bit of your management accounting from the old syllabus. Costing is what popular is called as. But anyway, so you have these 19 broad chapters. This is just for your recap purpose. Now, quickly, I'll take you through individually, question by question, from which area they've asked and how you could have approached it. Question number 1 is technocrats invited applications for 1,50,000 shares. So this is on issue of share capital and they have issued the shares, and there is something called as failed to pay the call money. So there is forfeiture, reissue. Is accounting for share capital? It's a typical problem. Looks big one, but it is not a complicated one. It's a typical problem where issue of share happens, forfeiture happens, and then reissue, and then you will transfer it to capital reserve. So 8 marks question, not a difficult one. Then the bank balance you have to prepare. Okay, that is also a great one. Okay, what are the restrictions on use of security premium? This is a tricky one because as a corporate accounting faculty, I don't discuss this much usually in regular classes as a separate discussion. I do tell in the course of discussing some problems like security premium has got a restricted use. It can be used for setting off of certain losses. It cannot be used for payment of dividends. It can be used for redemption of preference shares or buyback of shares. So restricted list because it would have been covered under company law. But anyway, not a difficult one, but a little bit tricky one, I have to agree. Second one, following statement is P&L. They have given then the balance sheet. Then they ask you to calculate current ratio, liquid ratio. Very, very straightforward one. Current ratio, current assets by current liability. Liquid ratio means from the current assets you have to take out stock. Gross profit, gross margin is there. Gross margin by sales into 100. Gross profit you can calculate. Net profit margin, net profit by sales 100 on equity, net profit by shareholders funds. I think that is not a great one, straightforward one. I hope students found it comfortable. The following balances appeared in the books of the company: sinking fund, redemption of debentures. You require to pass a journal entry. Okay, sinking fund will be there. You sell the sinking fund, whatever profit or loss, you take it to P&L, and then whatever the amount remaining in sinking fund, you will transfer it to general reserve. Again, debentures were there, redemption debenture, interest on debenture. How will you deal with the debenture sinking fund? Okay, this is what the question they asked. You will transfer it to general reserve. Okay, this is also not a great one, difficult one. They have given the income statement. They are forecasting 25% increase. Cost will be 70%. You are required to compute the projected net income and growth rate in dividend. This problem is on forecasting. Just you have to prepare in a columnar statement and one more column, increase whatever they have given information, the new profit will come and new dividend will come. Not a difficult one. XYZ Incorporated, there is the shares of underwriting, account related aspects of company accounts, underwriting. They have given they have received the shares which were marked applications. They have given calculable individual director as straightforward what you can get. You calculate on a columnar format, start with gross liability, subtract marked applications, subtract unmarked application in the ratio of gross liability. The difference what you get is individual underwriters liability. The following balance were extracted: preference share, premium. The company redeemed preference shares, related aspects of company accounts at a premium of 5%. And it issued the shares at premium of 1 rupee for such amount was necessary for the purpose after utilizing the available profits. So as you know, for the purpose of redemption, you can take security premium, you can take general reserve, you can take P&L account. So from the amount of issue of preference share, face value of preference share redeemed should be sourced based on two sources. Source number one, that is either by issue of shares, which you can say equity shares, or by transfer to CRR from free reserves. So the face value of redemption, 5,000 shares of 100 each, which is 5 lakh, and at a premium of 5%, so it will be 5,25,000. So general reserve you have 1,60,000, and you have profit and loss account 1,18,540. Add these two numbers and subtract 5 lakh. 5 lakh is there, but here you need only, you have only 1,18,540. So from the 5 lakh, subtract these two amounts. Whatever remaining is by way of issue of equity shares. So that is what this problem. You are required to pass necessary journal entries. Not a complicated one. You should be able to follow it. Summarized balance sheet of the company is given, assets and liabilities. They decide to issue one bonus shares and repay debenture at a premium of 3%. So no connection between the two. A bonus shares means from the free reserves which you have a security premium, statement of profit and loss. So using these two, it will be transferred to shares without any consideration, and that is called as bonus shares. And repay debenture, debenture account debit to bank. So again, one way you repay, the bank balance will come down. Another way, you issue the share, reserves will come down, share capital will increase, and you are going to pass a journal entries. Record the above to meet the above resolutions. So record the above means you have to pass the journal entries. Not a difficult one. X limited, H limited 20. This is a consolidation problem. They have acquired in stages 25%, then 37.5%, then 37.5%. So basically overall they have acquired 100%. And ascertain the share of parent company profits on the date of acquisition of these shares. So this is a slightly tricky one. So what you should do is, as on 1st of April 22, what was the reserves? The reserves was 1,25,000. So 25% is what the holding company shares will be. During the year 22-23, net profit earned was 50,000. So this should be divided in the proportion of number of months. From April to September, that is 6 months. And from October to December, 3 months. And from January to December, 3 months. The reason is the first 6 months you are handing 25%. So you should allocate 25% to holding company, 75% to outsiders. Whereas on where you obtain 37.5%, you obtain it on 1st of October 22. So from that date, that is from the 3 months what you have to allocate 25 plus 62.5% something you get. So that should be the ratio in which you have to allocate, and last 3 months you have to allocate in the ratio of, there's no allocation, I think everything belongs to the holding company. You have to allocate like that. Very interesting question. Allocation is a tricky one. This kind of problem, I must admit, I have not covered even in my classes. Definitely a tricky question in this aspect. Point B, this is also consolidation, but mind it, point B is a different question from point A. Don't mix the two, don't get confused. They have given the March 23, on 1st of April they have acquired 3,000 shares. 3,000 out of this 4,000, so 75% share capital. You have to calculate goodwill capital reserve. So if you prepare in my columnar format, you can get the answer in with a fraction of a second, not fraction of a second. You will be able to get the answer very faster. Particulars amount, goodwill or cap reserve, con PL, NC, minority interest. You follow this format, this problem is a cakewalk. From the following, prepare cash flow statement. Cash flow statement, you can only prepare direct method. So in fact, I think same problem I have covered in my class with the same numbers also, if I remember correctly. So opening balance, closing balance you take out. Then you group this into operating activities, investing activities, financing activities, total it up, add opening balance, you get the closing balance. Straightforward one, very simple one. Then theory question, 3 golden rules of accounting. You should know debit the receiver, credit the giver, debit what comes, credit what goes out, debit all expenses and losses, credit all incomes and gains. What is meant by XBRL? That is online way of submission for the large companies. How does it work? So theoretical explanation. What is the needed convergence IFRS? Because globally everybody is converging towards international financial reporting standards. India has adopted a way of slowly converging, which is why they have introduced Ind AS. Anyway, you can expand more. Then question number 5, the mechanized standardized Chandler segment, economic level, middle class, share capital, debenture, fixed assets. Okay, this part 2, this financial management. So they have given the data about the raw material, wages, overheads, components for average for 2 months. So this typical problem looks like working capital. So you know how to follow a working capital estimation. You start with like a material cost, wages cost, overheads cost, profit total. Then you start the you prepare the working capital estimation. Start with current assets, under that raw material, annual consumption into holding period by 12 months. WIP, I think they told WIP involves 100% of material, 50% of labor and overheads. Proportionately calculate. Similarly, you calculate the debtors on the selling price basis, subtract the current liabilities. Current liabilities means creditors should come. Then creditors for overheads should come. Then creditors for wages also should come. That will give the working capital estimation. And then you can forecast a P&L account. Anyway, sales information is there, cost information is there, profit you can ascertain. Prepare a forecast balance sheet. Apart from these information, they also have given the fixed assets, debenture, share capital and all. So you can fill up the balance sheet also. Okay, then coming to the next question, providing the information, cost of a product, material, wages, factory variable, fixed overheads. This is the operational aspects of your chapter, operational aspects. Profit volume ratio, that is what gross profit by sales. Break even point, fixed cost divided by gross profit ratio, profit volume ratio. Margin of safety, actual sales minus break even point. Profit, sales minus all these expenses will give you the profit amount. So this is a simple one. So equipment A has a cost of 75,000, cash flow 20,000, then 14,000, net present value. NPV you have to calculate. Means you have to divide the data into 3 parts. Initial cash flow, that is what is 75,000, initial investment. Interim cash flow, every year you get 25,000 per year for 6 years. And then equipment B would cost 50,000 and generate cash at 14,000 for 6 years. So you calculate the incremental cash flow from the existing equipment, how much you can get, or equipment A, and the new equipment B, how much it would cost. Incremental cash flow, then you apply annuity factor, means every year discounting factor is there, sum it up, you get the present value. If you have any scrap values there, okay, nothing is there. Present value you get, subtract investment, that will give you the NPV. And profitable index means present value of inflows divided by investments. You have to calculate both the equipment. So don't calculate incremental cash flow. Calculate for A separately and calculate for B separately. The following is the extract of financial statements, operating profit. Okay, calculate EPS. EPS, how do you calculate? Start from sales. They have given operating profit. So you have profit. You don't have to worry about income statement. You have net profit, divide by number of shares, 200 share capital, 10 rupee face value. Profit by number of shares will give you EPS. And percentage of cost of capital of the company for debenture and equity, cost of capital chapter. For debenture, it is interest into 1 minus tax by debenture, and for equity, you can use the formula of the growth rate in equity, that is earnings per share EPS divided by the market price is there, plus any growth rate information available. Then point D, this is regarding M&A model. This exact same problem, if I remember, numerically I would have covered in my classes. So when the company pay dividend and when company don't pay dividend, how do you calculate the value of the company? In both cases the value will be same, and that is why it is called as M&A model, as dividend irrelevant theory. Then few theory questions are there. What do you mean by Arur indicator? This is a very tricky question. Yeah, this is like one chart is there, it will tell you when to buy, when to sell. Even a technical trader like me don't use this practically, but they have asked. Even in my classes I have to admit this particular question I have not covered, but it's a tricky one. Hamda equation. Hamda equation, the name is slightly looks unfamiliar, but Hamda equation is called as, in the portfolio management we discussed this, it's called as levered beta, unlevered beta. So if a company takes loan, they will have more risk and therefore their beta will be higher. If company don't take loan, their risk will be less, that is called as unlevered beta. So when you take unlevered beta, adjust debt equity ratio, what you get is levered beta. That is what is Hamda equation. Annuity due, annuity ordinary, that is basically difference between whether annuity is paid at the end of the year or annuity is paid at the beginning of the year or beginning of the period. Briefly explain emerging role of financial management is from the chapter 1, theory 1. So that's the end of it. Overall, if you observe, the question is spread from all the chapters. So dividend question was there, working capital was there, cost of capital was there, capital budgeting is there. And even from the accounting, they focus on all the areas. So you can't leave any chapter, that is one thing is very clear. Second, you will not get 100% easy paper and 100% tricky paper. It is always a mixture of it. Depending on the mixture, I would call whether it was a difficult paper or easy paper. In my opinion, in this situation, I would say around 85% are straightforward questions, around 15% are tricky questions. Overall, my take is this paper should be easy from the student perspective if they are conceptually prepared. So with that, I leave you. See you next time. Till then, take care. Bye-bye.